How do you set up a private foundation? Have you ever thought about how to create a private foundation? It can be a fantastic way to give back while also benefiting from tax advantages. Let's break down the steps involved in setting one up. First, you need to define the foundation's purpose and mission. This is not just about what you want to achieve, but also how you will describe it in legal documents. A clear mission will guide all future decisions. Next, you will legally from the organization. This typically means incorporating as a nonprofit corporation in the state where you plan to operate. If you choose to structure it as a trust, you will need a formal trust document. This document must specify the charitable purpose and include the necessary language for tax-exempt status from the Internal Revenue Service. After that, you will need to obtain an employer identification number from the Internal Revenue Service. This number is essential for all tax and legal filings and is required before applying for tax-exempt status. Now it is time to apply for tax-exempt status. You will submit Internal Revenue Service Form 1023. This application details your foundation's structure, activities, and financial plans. The Internal Revenue Service will review this form to see if your organization qualifies as a tax-exempt entity under Section 501(c)(3). There is a user fee for this application, so be prepared for that cost. Once you receive tax-exempt status, you must comply with ongoing requirements. This includes filing Internal Revenue Service Form 990-PF annually. This form reports your foundation's income, expenses, grants, and other activities. Depending on where your foundation is incorporated or operates, state filings may also be required. Keep in mind that private foundations are subject to an excise tax on net investment income, currently set at 1.39%. This tax is reported and paid annually as part of the Form 990-PF filing. Additionally, there are minimum distribution requirements. Each year, private foundations must distribute at least 5% of the average value of their investment assets for charitable purposes. If you do not meet this requirement, you could face penalties, including a tax equal to the amount not distributed. Directors and trustees are responsible for ensuring compliance with these requirements. This includes accurate record keeping, timely filings, and proper calculations of distributions and taxes. From a tax planning perspective, private foundations can be a great tool for high-income earners. They allow you to manage and distribute wealth for charitable purposes while enjoying tax benefits. This structure gives you control over your charitable giving and can be an effective part of a broader tax strategy. You can use the foundation to support specific causes, involve family members in philanthropy, and potentially reduce your taxable income through charitable contributions. However, keep in mind that the administrative and compliance burden is higher than for public charities. Ongoing management and professional advice are often necessary. Setting up a private foundation requires careful planning, legal formation, Internal Revenue Service approval, and ongoing compliance with tax and reporting requirements. For high-income earners, it can be a powerful tool for tax planning and philanthropy, but it demands attention to detail and regular oversight.